Now we're going to look at a scenario when the borrower is short to close. And that means the amount of money available from the reverse mortgage is not enough to pay off their current mortgage. That borrower would have to contribute funds in order to get the reverse mortgage. 70-year-old homeowner, no birthday coming up anytime soon. Property value is $750 in Utah. They self-report excellent credit, a car loan payment of $350 a month. Credit card payments minimum is $125 a month. They live in a single-family home, husband and wife, no HOA community, 2,000 square foot home, and that's all the real estate they own. Their income is $5,700 a month. They've got 15 grand in the checking and saving accounts and 125,000 in IRAs. That's all. No other financial assets. Their mortgage is $295,000. They got an $1,800 a month payment. They got the loan 4 years ago when rates were low, so 26 years left to pay. There are impounds on this account, on the payments, and $4,500 is their annual property taxes, $1,500 for insurance, and they have no other liens on the property. When we click on Get Results, you'll see a chart that's similar to what you've seen in other scenarios with an important difference. Here you do not see any yellow line because there is no line of credit. The only way they're going to start off with a line of credit is if they pay more than what we need just to create the reverse mortgage. Say they kicked in an extra $2,000. Then you'd see a tiny yellow line down here with that opening $2,000 line of credit balance. Now, one way that I think is important to illustrate how a reverse mortgage could benefit someone like this is, well, just imagine if you never had to make any more principal or interest payments on your mortgage. And you wanted to retain the same amount of equity that you have now, $455,000. Well, if your property appreciates at 2.87% per year, you'll get there. Your home property value now, $750,000, will go up to $1,147,000. Your mortgage balance will go up from $295,000 to $692,000. It's going up, as you can see in the green section of the chart here, because you're not making any payments. So we're going to add interest and FHA insurance onto the loan balance over time, and that's why it's going up. But if the property appreciates at 2.87% a year, you won't lose any equity. You'll have an important cash flow benefit. You're not making $230,000 worth of payments of principal and interest on your current loan, so that's a cash flow benefit for you. If your property appreciates a little bit more, say at 3% a year, well, then you will have a little bit of an equity benefit, $21,000. If you live longer than 15 years in the reverse mortgage, say you go for 20 years, well, you're not going to have quite as much equity benefit. Still, it's $1,000 more than what you started off with without making any payments. Right now, you're about $4,000 short. We got a home value of $295,000 and equity, and your current monthly payments are $1,800. That's principal and interest. Your current mortgage, the reverse mortgage approval is only $291,000, so we're short by $4,000. We've got to pay this one off, or it has to be paid off in full to create a new reverse mortgage. So you could just continue paying that $1,800 a month for 2 more months, and then you'd get pretty doggone close to the $4,000. Technically, it's $3,614. We just rounded up to the $4,000 in this case. What can influence the amount of equity you have in the future is not only your property value appreciation rate, but also future interest rates. This shows what the actual interest rate has been for a reverse mortgage. And it's not just the interest rate, it's the 1-year treasury rate, plus the margin for the lender, plus 0.5% for FHA. And as you can see, it's gone up and down over the years. This is just the historic average. If you say that, well, maybe I think where interest rates are right now, maybe it's going to stay that way for the next 20 years. That's closer to 6%, as you can see on this chart here, and that will impact your numbers up here. Here you'll be losing equity of $117,000. You still have a net positive impact because of the cash flow savings. And if you think 3% is not really right for your neighborhood, maybe 4% is more appropriate, then you kick it up there and you gain equity during those years. And you can always figure out what's the number I have to hit to not lose any equity, and in this case it'd be 3.26%. Check that, that's for the 15 years. There we go, kick it to 15 years, and you go to 0. Right, because that's locked into their expected life according to the Social Security actuarial table. When you kick it back to the 20 years, they will be losing a little bit of equity during those 20 years, $47,000. You can try different interest rates. This just shows you the legacy mortgage payments you're no longer making. That's the source of your cash flow benefit here. So once you've gone through this and tried different rates and property value appreciation rates, if you want to move forward and look at the actual numbers, here's where you go to the summary page. Main cash flow benefit for this one is no mandatory principal or interest payments on the reverse mortgage. Important facts you need to understand: there's no personal responsibility to repay the loan, no recourse to the borrowers or the heirs. You can hold your home in a trust as long as it meets FHA and lender guidelines. The heirs can repay the reverse mortgage when they inherit the property by selling your home or refinancing into a new mortgage. It's a very transparent process. So you can go through these with your borrower to kind of help them understand how this helps them, if it helps them. Bottom line is, if you're saving $300,000 of cash flow, are you willing to absorb some initial fees to get this process started? The initial fees consist of third-party costs like title insurance, escrow, similar to what you get in a conventional 30-year fixed. The origination fee is set by FHA in terms of minimums and maximums. This is the maximum, kind of like points in a conventional mortgage. And the FHA fee is 2% of the property value, capped. And this is below the overall cap. The chart that you saw before is based on tables. The numbers come from these tables. These are your cash flow savings every year by not making principal and interest payments anymore on that current mortgage. You had to pay us $3,614 to get the loan done. That's negative cash flow. And this just shows what your cumulative cash flow will be over the years. This is what we use to create the estimates for the equity in the future and the loan balance. The equity is real simple: property value minus your loan balance equals your equity. Your loan balance is based on any payments that we make to you or you make to us. In this case, at the end of year one, you really didn't make any payments during the year, just at the beginning to get the loan created. So it's really just about the interest being added onto the loan plus the FHA insurance, and that's what creates the growth in the loan over time. Here's just the initial setup for the loan. Basic numbers we've gone through before. Starting rate's 5.38%. In this particular scenario, not every mortgage is like this, and rates change over time. In addition to that, there's a 0.5% for FHA, so your actual rate is going to be a little bit closer to 6% for the accrual of the loan balance. If you like what you see and you want to get going, click on Next Steps. That's where you can enter the borrower information, the younger borrower and the older borrower. They might want to add in some information here about what they're looking for. In this case, it'd be end current mortgage payments. That'd be their motivation. When you click on Continue, the borrower is going to get a short email confirming we have the right email address, and that'll get the ball rolling for sending out a proposal and such. If they're not ready to commit to personal information just yet, you can help them download a copy of the scenario that was just created. They can share that with their financial planner, their realtor, their CPA, their adult children, whomever they want to. Just open it up right here. They can print it. If you're running the show on a Zoom, you can download it and email it to them. Gives them the chart showing how much equity they'll have in the future, still a very healthy amount based on these assumptions, and kicking in the little bit less than $4,000 to get the ball rolling. The next video we're going to have is what happens when somebody self-reports that they got below average credit. They're similar to these, but it's an important one to understand. So stay tuned for that one.